What is up, everybody? Welcome to the Prime newsletter for the review of the January numbers. So we'll go ahead and get started right into it. The average sales price rose 1.26% year over year to just over 245,000. Median sales price was up 5.5% increase year over year, which is really kind of up there for January's numbers, up to 193. Total sales 1760 is a 4.6% increase year over year, which is really good for the January timeframe. Average rental price was up 2.3% to just over 1,400. Employment numbers, the Bureau of Labor Statistics has taken a while to get their information out, so I was only able to get the December numbers, but we're just over 1.13 million in employment, was 3.3% increase year over year, and we gained just under 7,500 jobs from the previous month, so that's good. Unemployment dropped 0.07 back to 2.98%, which is way below the national average. So unemployment here in San Antonio is doing great. Month's inventory shot up quite a bit, but nothing to really kind of worry about. It's kind of seasonal. You'll see on the next slide that January is typically the lowest median sales prices, the highest month's inventory. So to see a jump of 1.5 months is nothing to be concerning, because everybody wants to list their houses in January. Wait till the new year after the holidays to list their house, so it kind of really shoots that inventory up. But that has a negative effect, is it suppresses median sales prices. So you can see here over 6 years, you can see these are our real estate cycles, that the summertime is the best time to always sell your house to get those median sales prices. And this dip down here is always going to be January. You see a spike in November, December, and drops off in January. So if you're timing your renovations, don't try to wait till, oh, I want to wait till the first of the year or something like that. Just go ahead and get them on the market and keep this stuff in mind on getting those highest prices when you're going to push those comps, or when you're looking into a property and wanting to start reviewing them and taking them on as renovations. Monthly rents, you can kind of see that follow the exact same thing. So for all you landlords out there, time your leases. I've been known to ask to do random leases of 8, 9, 10, 11, 13, 14, 15 months. So I'm ending a new lease right around that April-May time frame, so I can get that next highest wave of rents. So when I want to increase, that is when my leases are up and potentially for somebody to move out. So you can see over time rents have continued to increase. I'm not sure what happened in summertime last year. It might have just been a typo from where I get my information, but you can start to see January prices are starting to increase again, and I would expect to see them continue as we move into the summer hot months for real estate. Here's your 20-year unemployment, so you can see that we have really dropped off here to the start of 2018 or December, finished 2017, and we've never been that low since way back into the 90s. So something that we're going to continue to watch, because I think that if I start seeing real estate prices or unemployment starting to spike and rise, I would expect to see that overflowing into the job market, because you can see here in a matter of just like 8, 9 months, we went from 3.5 up to 7.5 in no time at all with the last real estate recession. So it's something, tracking unemployment to me is a very important factor to understanding our real estate cycles and trying to predict and determine which direction real estate prices are go and the overall health of the economy. So something I added a couple months ago was the year-over-year appreciation, and you can kind of see here how fast these appreciation numbers go from negative to positive. I mean, we have a 12% swing pretty much from January 12 to April 12. So that's when you start seeing that, you know that we are starting to pick up in real estate and with the cycles. So one thing I am noticing in here is real estate is starting to slow down here. So you can see here in 13 we had 10%, 14 we had 10%, 15 we had 12% or 11% appreciation, and you can see that we've seen a downward trend where we're not peaking as high, to where I think we're going to start seeing appreciation starting to slow down here in San Antonio, but it would still remain positive and revert back to the mean of the average prices of 3 to 4% a year, which is the historical average. So we've been really up there, kind of erasing these negative years that we had from the real estate recession, bringing us back down to 3-4%, and now we're hitting up to where we're starting to see affordability issues into those median sales prices as they encroach up into the 200s. So now the most popular part of this is where to market. Where's the hottest zip codes that are going to see the most economic forces for price to increase? So when people are wanting to find those rehabs, they have the best chances to catch a market that is going to continue to rise while they're doing renovations, which is always a bonus. Even though we run our CMAs pre-doing our rehabs, it's a good indication saying, hey, there's a high demand for property in this neighborhood. There's not very many properties being listed. So there's a good chance that my ARV might increase 5,000 to 10,000 while I'm rehabbing over the next couple months. So I do it by price range and by zip code. So you can see where we have the highest demand for housing is in that 150 to 200,000 entry level standpoint. Now this is across the entire city. So to see less than 3 months of inventory across the entire city is, that's pretty low, and it's been that low for a very long time. And I expect it to stay kind of that low. But one thing I'm starting to see is this number, this gap is starting to close. But there still is a significant difference, almost a 1 month, when you start going from the 200 to 250 price ranges. So it's something to keep in mind, as well as like, where are my buyers wanting to buy property? Where is the bulk of my property? Where's the most in-demand inventory in the city? So I'm a licensed real estate agent, and I've represented some buyers in this 150 to 200,000 price range. And you as a buyer don't have much negotiating power. A way to look at these numbers is a balanced market is said to be at 6 months of inventory between buyers and sellers. So anytime we start dropping below, down to just 3s and the 2s and the 1s, it's showing that there is a strong seller's market. Since they have a property that's in high demand, not a lot of properties are being sold in that price range. They got a lot more bargaining power than in a buyer up in this 150 to 1 million, where there's almost 13 months of inventory across the entire city, to where a buyer can come in and say, hey, you know what? We're going to offer you less than what you would have offered on the property, and they don't have a lot of negotiating power because there's a lot of homes to choose from on the market. So now by zip code, the most in-demand zip code, which has shocked me because these two zip codes, 78251 and 78250, are very large zip codes over on the northwest side of San Antonio. And to see them down in the low 2s shows there's a lot of demand and not very many houses being listed over in those areas. And to see the average sale prices in that sweet spot of that 150 to 200, there's going to be a lot of forces for those prices to continue to increase. One thing that reminds me of is 78247, which is down here in the bottom. About a year ago, it looked very similar to 78250 as far as months inventory and price range, and now it's shot up clear up into 190. So it's seen an increase of 25,000 in the last year in the average sales price because it's been saturated with people. The prices have increased, and now it's starting to price out where buyers can afford. So this is something to take into account of where remember, this is the most in demand in the city, where there's the lowest number of houses with the highest houses being sold. So there's a lot of demand and a lot of economic forces for supply and demand to push those prices up. So now you have the worst zip codes. This is not to say these are bad zip codes to invest in, but they are you can see higher price zip codes, 300,000 up to 700,000. So now there's 8 months of inventory. So now that's something to keep in account. If you are renovating in that area, you want to take in your sales time, especially if you're in a hard money loan or your cash is tied up, how long it might stay in that property. And it's also a way to determine how high end you need to go with your rehab, with the pictures and your staging, to make sure you're not one of those properties sitting on the market for those 8-9 months. So really keep that in mind and know your market when you're analyzing a deal, to say, okay, how long am I going to hold this? Look at how many properties are listed on that day, and then how many properties sold in the last month, and it'll give you an indication to say how many properties are usually selling in this neighborhood, and how much choice does a buyer really have. So, because if you're in a hard money loan, you do not want to be paying hard money costs and interest on a $400,000 loan for 8 months, because that can really eat up your profit. Or if you do, you just want to take that into account and make sure your purchase price is much lower than that. So that really wraps it up for this month. Go ahead and check us over at Prime Homes. Shoot us a like over on Facebook. And if you guys have any questions, always feel free to email me at john@primehomes.com. Otherwise, we will see you guys next month.